Imagine waking up one morning to find your country's money is suddenly worth 10% less than the day before. This is not a theoretical exercise. It has happened, and when it does, it sends powerful ripples through an entire economy and across global markets. On January 15, 2015, the Swiss National Bank made a surprise move that sent its currency, the franc, soaring by as much as 30% in minutes against the euro, effectively ending its policy of keeping it weak. This single decision caused market chaos, bankrupted currency traders, and instantly changed the fortunes of Swiss businesses. This shock shows the power central banks hold. So, what does it mean to devalue a currency? It is a deliberate move to lower a currency's exchange rate relative to others. The primary reason countries devalue is to gain a competitive edge in trade. When a currency falls, exports become cheaper for foreign buyers. Think of it like putting your country's products on a global sale. If a car costs $30,000 and the euro is 1-for-1, a European pays 30,000 euros. After a 20% devaluation, that same car costs 24,000 euros. Lower prices can surge demand for exports, boosting domestic sales. But devaluation also makes imports more expensive at home. A $50,000 machine that cost $50,000 now costs $62,500. This dual effect is the core mechanism of devaluation. The goal is to improve the trade balance, sell more to the world, buy less from it. A better balance can strengthen the economy and reduce reliance on foreign borrowing. Strategy: shift activity inward, encourage local production and consumption. It is a deliberate trade-off to manage economic destiny. Governments do not take this step lightly. Devaluation is powerful and controversial. Exporters are the immediate winners when a currency weakens. Their goods become more competitive without cutting costs. A Japanese car maker, a Chinese electronics firm, or an American farmer can win market share or higher margins. More orders mean higher production and hiring. The supply chain benefits: more steel, more tires, more local components. Activity cascades, supporting jobs and revenues nationwide. Tourism also benefits as hotels, food, and attractions become cheaper for visitors. Inflows of tourist spending lift local economies. When imports get pricier, domestic alternatives gain appeal. Producers competing with imports can win back customers. This shift preserves jobs and boosts self-sufficiency. Stronger activity raises tax revenues, easing budget deficits. Firms earning abroad convert to more local cash, servicing local currency debts more easily. Devaluation can be a powerful stimulus for growth and jobs. But devaluation also creates losers. Import-dependent businesses see costs jump for raw materials, components, and machinery. Airlines pay more for fuel, builders pay more for imported steel. Firms pass costs to consumers or take a profit hit, risking cutbacks and layoffs. Households, especially lower or fixed incomes, feel the squeeze. More expensive imports raise the cost of living, imported inflation. Paychecks stretch less, purchasing power falls. Savers lose value versus foreign currencies. Goals like foreign travel or imported cars get costlier. Foreign currency debts become heavier in local terms. Each payment requires more local cash, risking insolvency for vulnerable firms. Frequent devaluations erode credibility, making future borrowing harder and more expensive. Devaluation reshapes capital flows across borders. Fast. Global investors chase returns, and currency stability matters. A devaluation is a loud signal to markets. It can trigger capital flight. Investors dump stocks, bonds, even property, converting into safer foreign currencies. Outflows can pressure the currency further, hit markets, and starve firms of funding. To stem outflows, central banks may hike rates sharply, enticing money to stay, but at the cost of slower growth. Yet weaker currencies can attract long-term investors. Assets look like bargains: companies and real estate. Good FDI brings capital, technology, and jobs. Confidence hinges on credible, predictable policy. Managing the narrative matters as much as the rate. China strategically managed the yuan to fuel export-led growth. For years, the yuan was kept relatively low against the dollar, within a controlled band. Cheap prices supercharged manufacturing and exports. The central bank intervened heavily, amassing the world's largest FX reserves. A sudden, modest devaluation in 2015 rattled global markets, showing how moves in Beijing echo in New York and London. Critics cited unfair advantage. China cited stability and gradual reform. The yuan has since appreciated in phases, with controls still firm. Japan confronted deflation and weak growth with Abenomics. The BOJ launched massive easing to weaken the yen deliberately. The yen fell over 30%, lifting exports and profits. Corporates boomed, markets rallied, optimism returned. But import costs, energy and food, hurt households. A clear trade-off: fight deflation, but mind consumer pain. Switzerland faced safe haven inflows that overstrengthened the franc. The SNB pegged to the euro to protect exporters and tourism. Costs ballooned as reserves soared and euro weakness loomed. The peg ended abruptly, markets convulsed. A stark lesson in the risks of currency intervention. In international economics, devaluation is a powerful double-edged sword. It can boost exports, production, jobs, and narrow trade deficits. But it raises import costs, erodes savings, and can trigger capital flight. China pursued export dominance. Japan fought deflation. Switzerland battled safe haven flows. Every tool, interventions, rates, pegs, carries trade-offs and risks. Used wisely within broader reforms, devaluation can help. Used poorly, it can hurt more than it heals.